Kia ora. My name is Catherine Leining. I'm a Policy Fellow at Motu Economic and Public Policy Research in Wellington, New Zealand. This video provides an overview of policy and price signals for low-emission investment in the New Zealand Emissions Trading Scheme. This is one of a series of videos that's being designed to help other jurisdictions learn from our experience. I'm going to provide a recap of key features, look at how the goals shape design, assess the outcomes for prices, emissions, and behavior, and look to the future. So our system has been operational since 2008. It was designed to cover all sectors and greenhouse gases, but the agriculture sector was deferred. Our system was linked to the international Kyoto market from 2008 until mid-2015. And our system has mechanisms to reduce exposure to emission prices. Our system had three distinctive phases of unit supply. The first was international linkage, when participants had unlimited access to overseas Kyoto units. Phase two, I called transition and review. This was a period of long-term uncertainty about what unit supply and prices were going to be doing. And in phase three, which we will be entering from 2021, we're going to have managed unit supply with auctioning under a limit, and we will have limited overseas units if the system were to open to overseas units in the future. So I'll go back to the beginning and look at how the original ETS goals first shaped our design. In legislation, our system had two goals. The first was to help New Zealand meet its obligations under the UN Framework Convention on Climate Change and the Kyoto Protocol. The second was to reduce New Zealand's net emissions below business as usual. Now, the legislation did not define business as usual. Underneath that were three policy goals that were adopted by the government. The first was least cost compliance with our targets under the international agreements. The government was very open-minded about whether New Zealand participants reduced emissions within New Zealand or overseas through using carbon markets. The government did want to expose our producers to the global emission price so that they were making efficient investment decisions. However, the government was satisfied if New Zealand's producers were among the most efficient in the world and our emissions and production went up, as long as we were part of a system where global emissions were going down. The government also wanted to prevent emissions leakage overseas. This led to the following features: unlimited supply of overseas Kyoto units, safeguards against potentially high global prices because we were fully exposed to global prices, uncapped output-based industrial free allocation, and the deferral of agriculture sector unit obligations. Here were some of the results, and I'm going to show you a series of figures to illustrate these. First, international prices set domestic prices until delinking caused price divergence. Participants surrendered cheap and low-quality overseas Kyoto units and stockpiled NZUs. Our price signals were too low to change gross emissions. Early price signals for forestry were largely reversed. After delinking in mid-2015, emission prices gradually rose to the level of the fixed price option and fluctuated with policy signals. Throughout, New Zealand has lacked a clear long-term emission price signal to guide investment in long-lived assets. The government also accumulated a large Kyoto unit surplus for the 2008 to 2012 target under the first commitment period of the Kyoto Protocol. The surplus was carried over post-2012, and the government is using some of that to help meet its target for 2013 to 2020. It will not be carrying the surplus into the Paris period. This figure shows what happened to NZU prices. So NZU prices are in blue, and the red line shows the price trend in CERs, Certified Emission Reductions under the Clean Development Mechanism. Our market also traded heavily in ERUs, emission reduction units from joint implementation, and they followed a very similar price path to CERs. So you can see that our NZU prices started below CER prices. That was largely because ours were driven by forestry. However, internationally, prices hit a perfect storm. We had the global financial crisis. We had major potential buyers who were not participating in the market. And we had low progress in the climate change negotiations for the post-2012 period. As a result, there was a surplus of CERs and ERUs, and the prices fell, and our domestic price fell along with it. This continued until late 2012. At that point, the New Zealand government announced that it was going to be taking its post-2012 target under the UN Framework Convention on Climate Change and not under the Kyoto Protocol. Participants reacted to this immediately. Now, the government was still hopeful that we were going to maintain access to Kyoto markets, but this signaled the possibility of future delinking, and immediately prices diverged. NZUs became more valuable than Kyoto units because NZUs had a long-term value in the system. This divergence continued until delinking was complete in mid-2015. After that point, our domestic prices continued to rise until they reached the level of the fixed price option of $25 a ton, and they stayed near that price level for quite some time. This shows the impact of that price trend on our new forest planting over 2008 to 2014. You can see that under the initially high prices, there was a lot of investment in afforestation, but once the prices dropped, so did the incentive for afforestation. We had tree nurseries that destroyed hundreds of thousands of seedlings because the landowners didn't buy them as they were expected. Now this chart picks off close to where the other one leaves off. And you can see that prices stayed around the $25 mark for a while. They rose once the government progressed its Zero Carbon Act legislation, which started to signal long-term ambition. Then New Zealand hit lockdown for COVID-19 and the price dropped $6 in a short period of time. However, when the government signaled its support for the emissions trading reform legislation and decided that it was going to increase the fixed price option from $25 to $35 in 2021, the prices rebounded. We broke the $30 mark for the first time on the 9th of June 2020, and the prices have remained high since then. And that is very interesting. Keep in mind that during this period, we've still been experiencing the economic impact of COVID-19, and our aluminium smelter has reported that it may close up in August 2021. Now, our aluminium smelter consumes 13% of New Zealand's electricity and is a major emitter in our market. So the fact that our emission prices have stayed this high shows that participants are setting the price based on long-term expectations of ambition. The market situation has created 3 opportunities for participant arbitrage at taxpayer expense. The first 2 were during linking. First, participants could surrender low-cost Kyoto units and bank higher value NZUs. This came at a fiscal cost to the government because it was putting on its books, giving out higher value NZUs and then recording low-cost Kyoto units that came back. Also, our post-89 forestry participants found a re-registration loophole. Here's how that worked. They could plant their trees and earn and bank NZUs. They would then deregister from the system and clear their harvest liabilities with Kyoto units. They could then re-register and earn more NZUs. Now, the government closed down this loophole with a legislative amendment in 2014, but this did contribute to a further growth in the banked stockpile of units. The third arbitrage opportunity has happened since delinking. Participants can use the fixed price option and then bank higher value NZUs. So if the government sells NZUs at $25 and it costs more than $25 for them to purchase overseas units to help with the mitigation, then that will come at taxpayer cost. This chart shows the pattern in unit surrenders over 2010 to 2020, and I've marked the period of linking in red. You can see the very heavy use of ERUs and CERs, and a little bit of use of RMUs, removal units from Annex 1 country forestry activities. After delinking, the supply shifted toward forestry NZUs and other NZUs. However, you can see in the last 2 years, we've had high use of the fixed price option once prices rose to that level. And you can see we had less use of the fixed price option last year, probably due to COVID-19. This chart shows the trend in ETS emissions and removals. You can see that the agriculture sector started reporting its emissions in 2012, but it doesn't actually have unit obligations. If you follow the trend in energy emissions in red, you can see almost no change over this period. What is interesting to observe is that over 2012, 2013, and 2014, you can see a peak in deforestation emissions and in post-89 forestry emissions. That's probably because landowners brought forward deforestation and harvesting when emission prices were very low. The profile below the line shows removals from post-89 forestry and other removals, and you can see the trend there. So we're hoping for a different future. First of all, ETS unit supply is going to be capped in line with 15-year emissions budgets and a 2050 target. This should create a long-term signal for pricing ambition. Secondly, industrial free allocation will be phased down through 2050. This means our emissions-intensive and trade-exposed producers will have more incentive to reduce emissions. Third, instead of having an unlimited fixed price option, we're going to have a volume-limited cost containment reserve and to help guard against high emission prices. We're also going to add an auction reserve price to guard against low emission prices. And finally, if participants are enabled to use overseas units in the future, they will be subject to a quantity limit, which did not apply in the past. Now, I've painted a rather negative picture of the impact of our ETS on emission prices and emissions, but I do want to signal how things are changing. So I'm going to leave you with a case study of Synlait, which is one of New Zealand's dairy processors. Synlait adopted a sustainability strategy which has included reporting of its corporate greenhouse gas emissions, targets to reduce both off-farm and on-farm emissions, and a commitment to no new coal boilers. In 2019, Synlait installed New Zealand's first electrode boiler for processing milk. The 6-megawatt unit is 99% efficient and saves 14,000 tons of CO2 equivalent per year. Keep in mind, New Zealand's electricity is over 80% renewable. Now, this is an expensive piece of equipment, and it took a government grant of $250,000 to help get it across the line. But another important part of the business case was that the developers assumed an emission price of $40 per ton in 2023 and $62 per ton in 2026. So here we can see that having a credible policy and price signal helped to influence a major investment decision. And that is what a successful ETS is supposed to do. So I'll leave you with a few key messages. First, people respond to price signals, so we need to set them wisely. Secondly, governments and businesses need to manage both high and low price risk in an ETS. There's a temptation to only focus on high price risk, but low price risk really matters. Third, policy uncertainty creates risks and costs for businesses. Maintaining broad political support for long-term policy direction is really important. Finally, ETS decision-making needs to balance flexibility with predictability and respond to changing circumstances. Motu has produced extensive resources on our emissions trading schemes, so I encourage you to check out our website or get in touch for more information. My contact information is here, and I will leave you with some more background information on Motu. Good luck with your emissions trading journey, and kia kaha.